So it has just happened again. As expected, the Fed just announced they're raising interest rates by 75 basis points. I thought it would be a perfect time to bring on my mortgage partner, Mark McDonald from Loan Depot, just to pick his brain about where we are and where we're headed. I definitely think you should stick around and listen to what he has to say. He's been in this business for well over 20 years and has a vast amount of knowledge. As always, if you have any questions or there's anything I can do for you in the future, reach out 24/7 and I'll get back to you as soon as I can. And again, I highly suggest you stick around and watch this video. And without further ado, let's get into my conversation with Mark McDonald from Loan Depot. Okay, well, good to have you here, Mark. I got Mark with Loan Depot. He's my preferred mortgage partner here in South Florida. And really, Mark, like I've told you before, what I love more than anything about working with you is that you are very, very proactive. And in South Florida real estate market, which is always competitive, in the last 18 to 24 months, I mean, I've never seen it so competitive as it was. And having someone that's going to make a phone call on the buyer's behalf to sell them to the listing agent, it's really, really critical. Plus your knowledge of all your, time in the industry is invaluable. So really quick, give us some of your background. And then I just wanted to pick your brain a little bit about where we are in this market.
Robert, thanks for having me on. Absolutely. Excited to be here. So background, I've been doing this 25 years. So I've been through an extreme buyer's market when NAFTA was signed. I've gone through the crash in 2007, 8, 9, and been through all of the different changes, ups and downs of the market, even through this pandemic. And being a manager for just a little over 18 years of that 25, I get to see a large volume of loan officer business along with overseeing large markets. So I have a pretty good sampling size that allowed me to be able to move faster than maybe some of the other managers. So I have a extensive background in being a loan engineer, really. So I appreciate the opportunity to be here, Robert. Absolutely.
Awesome. So this is great timing, obviously, because of we've been talking about doing this for a while, but just the market, the crazy volatility, and we just had the latest rate hike. So what I really wanted to ask you was, what do you see going forward? I mean, from this point, because I mean, that's all anybody's talking about. We have a lot of buyers that are kind of on the fence. They were before, but now really on the fence and kind of concerned about what we can expect. So what do you see moving forward from this point, as far as, I think interest rates, they're forecasting might go up again, but what do you see going down through this year and the next year as far as, rates and what we could expect in the market?
Yeah, that is on top of mind for a lot of people, right? And there's a lot of noise out there, and I see some of the things that people are saying on the internet, and they're so wrong. They're not even close to being accurate. We, like a lot of us top managers, especially at Loan Depot, we subscribe to experts that all they do is research the stuff too. So a lot of the stuff that I'll share with you right now is really coming from a lot of their expertise, and my opinion being a manager of a high volume team in the mortgage industry. But the Fed meets 8 times a year. And it's met the 6th time and raised interest rates, as we know, on the 22nd with their announcement, another 0.75% of what the offer to the banks. So that's not necessarily reflective to what interest rates actually do, but it does move rates up for sure, because if banks have to pay more money for the money that they get, of course they're going to pass it on to consumers. So but it's not a 0.75 actual literal increase in rate. The Fed's going to meet 2 more times, and for those that are very interested in this, definitely watch the Fed chairman's 45-minute, 30-minute meetings. I get a lot out of them, but they made it very clear that they hope to have maybe another 1.75 or 1 point more increase before the end of the year. And what is kind of interesting about that is what the strategy for the Fed you have certain tools to be able to stop inflation, and their goal is to get inflation to 2%. We're at 6.3% is what they said the other day. So they're at 6.3. They got to get it to 2%. How are they going to do that? So they have a bunch of different things that they've done over the last whatever period of time. One is for investment homes and second homes. They try to take them out of the market. So they've jacked up their cost of their rate almost by 1.5 to 2 points, which is like 200 basis points. 100 basis point equals 1%. So they've done that to try to like slow those buyers, take them out of the market, so that way buyers that are really homeowners can have an opportunity to still get homes and not deal with this runaway inflation. They've increased interest rates to try to slow down the housing market, along with a whole bunch of other things. But this is kind of a really unique market because we were not really hurting before. It's not like what happened when NAFTA was signed, where that a whole bunch of industry had left the U.S. and unemployment rate went up. It's not that. And it's not 2008 where where I struggled to find money to be able to lend out because they were literally making decisions and companies shutting down, and it was impossible to get money out to people. So then of course, that buyers that were there couldn't get a home. This is very unique. You have an enormous amount of buyers that sat still for a long time. So you have this huge demand of buyers. Situational buyers too, by the way, where they situationally needed to move. Like their lease was up, their job transferred, they got certain things that gone on, but they were unable to do it either because of COVID, or they just weren't able to find a home because everybody was on a pause button, and then a flood of people come storming the market, and then there's not there. So then sellers taking advantage of that, right? So it's like a temporary thing. And I'll bring you back to the Fed. To my point with what he was saying is that there's resilience currently in the US. People have a lot of money. I know that the gap is getting larger of the haves and have-nots, but just all in all, people didn't spend money going on vacations like they did. They didn't buy the type of cars they did. They didn't buy. They have money, and they're not in this huge financial crunch. The unemployment rate is really low, he was saying. So what is the resilience of the US? So they're doing all of these things, but what is the resilience? And it really comes down to, we got two parts of the government fighting each other in a way to save our economy. You got enormous amount of printing money, I call it, where they're dumping trillions of dollars of our tax money into the market. And then you got the Fed going like, oh crap, how do we get inflation back down to 2%? Because the politicians didn't think about that when they gave these great little ideas to everybody.
Yeah, that's what's got me concerned is if they keep spending, it's just impossible to get it under control. So that's the only thing that I worry about,
Well, hopefully they don't spend any more. And you got now the Fed's going to, because of all that spending, people get ready. And all those that wanted to have these great little programs to help the lower income people are going to get ultimately screwed because inflation, paycheck to paycheck, inflation is going to take away all of that money quicker than it ever was given to you. And that's why you have a lot of camps that were saying, don't do this. And everyone else was like, why wouldn't you want to help people? Well, because the people that are saying that let's print all this money and do all these programs don't understand the economics of the US. So now you'll feel it. Now get ready. We're going to, in order to get the inflation down to 2% to save, because if they don't, we're going to deal with what happened in the 80s and interest rates go to 18, 20%. So it's like a Band-Aid. It is their goal to crush the economy back down, get unemployment rate up. I know it's going to hurt some people, but it'll be less hurt than having an inflation go so high that you create a bigger thing. So they said, back to the Fed again, they want to raise rates another 0.75, and they're going to keep on hammering it until they bring the economy. But I say to you, what is the resilience of the US? Lots of people have a lot of money. They have now a lot of equity. We're seeing a lot of debt consolidation loans going on. I think we've seen a stat before. There's $53 trillion worth of equity if somebody pulled out up to 80% of the value of their home. That gives a lot of people backup plans, in my opinion.
Right.
that have real estate and that own money. So to answer your question, Robert, in a long way, I feel that rates probably going to be sitting in the sevens for going into first quarter of 2023.
Right. So I agree with you. And one thing, when people talk about having another crash, I just can't see that happening because everybody was so over leveraged back in 2005 to 2008. They couldn't, I mean, the only thing that would happen now is that if prices go down, there's so much equity in these houses that they're just going to have to lower the price and sell. I mean, it's just markets go up and they go down. Inventory is another big deal. So we still have very, very low inventory. And I was looking at some stats. I think back in 2008, I think we had somewhere, I think it was like, I forget the number, but basically we have right now months of inventory is like right at 2.
Yeah.
I mean, I think there was like, I think it was like 8 times the amount back then. So there's still that problem with the inventory. Another thing that I don't think buyers, so for someone who's on the fence about buying because of the interest rates, you predict they're going to go back down, or do you predict that, say in the next year or so?
Well, I really do. I mean, everything's cyclical. So
Yeah.
the answer to the question is I do feel, but like, when will that happen is the big unknown. But will it be a big crash, to your first question, Robert? I really, we don't see this as a crash. We see this as
Adjustment, really.
to 2%, right? And so they're trying to get the economy to slow down. So like, hello, people, it's supposed to slow down. It will happen. Will it be a crash? We're far from a crash. Unemployment rate is so low. We're not even close to 2% inflation. Like, they got a lot of work to do. So get ready. It's going to be hopefully a slowdown, a short slowdown. So that way, once we're fully in a recession, because that is the goal, fully in a recession, then rates do come down. So to answer your question, yes. Do they feel it'll happen in first, second quarter? It's all about the resilience of the U.S. When will this really break? Do we have to be in the 9s or 10% to do it? Do we have to be in 11 or 12? Or will this next couple interest rate hikes do it for us? I mean, that's going to be a big question.
So for someone that's been on the fence because they don't want, I mean, even the rates right now, historically, this is kind of like normal, right?
Yeah, I would
6%, something like a little over 6. It's not the rates we had during COVID or right after COVID. That was artificial, right?
Yeah. So the rates that we're at today, which I think they said the average or whatever was in the 6.5 range. Right. So today, after all of what's happened, especially in the stock market that happened yesterday, we're pushing high 6s, low 7s, depending on your credit score. Good credit score individuals with large down payments will definitely still be in the 6s. 2 parts of the answer to that. You got the interest rates are going to be going up. So if your situation calls for you to buy a house over the next 6 months, buy it now, or even let's say over the next year, buy it now. The risk of the rates going up is going to cost you $200-$300 extra a month in mortgage payment, roughly. Depending on, like, let's say a $400,000 loan at 6.5%. You're and then let's say it goes to into the 7s, you're going to see a $200-$300 increase in monthly cost for that same product. And then you got the housing market, like you said, inventory is still low. I heard the other day, somebody else, not an expert like you, Robert, but they were saying like how the market has shifted. Well, not really. You have inventory is still below 6 months. Inventory of houses is below 6 months. And us lenders, we see if the inventory is less than 6 months, it is still a seller's market.
Right.
So those that are saying it's a buyer's market is wrong. When the market starts to go 6 months, it's balanced, and then it starts to go greater than 6 months. Well, now you're going to start to see buyers have a little bit more of an advantage. But the closer we get to a 6 month average, now things that used to happen will start happening again. Like, for example, before, like, there's $25,000 you can get that we have right now, grant money for pretty much a huge sector of, like, call it all your 911 group of employment, like your nurses, firefighters, doctors, the medical field and the police. So there's all of these, all this money that's available that people were not able to get a seller to accept their offer because they thought it was, I'd rather take a cash offer or a
Absolutely.
large $30,000-$40,000 over appraised value offer, which now that's not happening.
Yeah.
So now you're going to start to see sellers become more receptive to the things that normally is normal in a market, I would say, which is accepting grant money, helping sellers with the seller concession. We just had one the other, I call it the inflation special, where the seller pays for 2% of the buyer's closing cost to buy the rate back down, so that way they feel what the rates were.
Yeah.
And so these are some strategies, but yeah, I see rates going up. They should buy now if they're doing it within the next year.
Yeah, and that's another great point you just made, is that a lot of buyers don't realize, first of all, you have more opportunity to get a house, but I think there wasn't like a perfect average, but I remember if you did not come out of pocket with at least 50 grand cash over appraisal, you had almost no chance.
Right.
Going back when we were at the peak, when things was really competitive. So saving that amount of money right now, because we're not seeing that. I'm still seeing, some houses that are going over, and you happen to offer over asking and, cover that with the appraisal gap, but not anywhere near as much. In South Florida, I guess it's a little different, because I'm like you, a lot of people are talking about this buyer's market, but not here. South Florida, we're not anywhere near that.
No. And
Yeah.
I think it's important to note that the market averages and that everybody's talking about may not reflect your current specific market, wherever you're watching this from. And like, for example, if you're in some remote part of Georgia or Alabama or even Florida for that matter, there's no industry around you. Point, you might have longer inventory, so then that's specific to your inventory. The higher price ranges in Fort Lauderdale, we've been noticing, or even Miami, have slowed down. The inventory has increased a lot larger, and it sounds like they're on the market for a little bit longer. But when you're looking at that sweet spot where the majority of all people are kind of buying in, that's kind of what we're more so talking about, right, Robert? That market part.
Absolutely. I'm seeing the same thing that we have been seeing, but just not as much. But it's really, we're nowhere near a buyer's market. But I do understand, people. I think it was the speed at which the interest rates have gone up. Like from the beginning of the year to now, we're like double, right?
Yeah, and I think that's a really great strategy, from everything that I've seen. Because they did it really slow in the 80s to try to curb inflation. And anybody that like I was, I think, in junior high in the 80s, but like it was slow to increase rates, slow to do the tools to slow things down to get the inflation down. And what happened? We went to 18% interest rates, right? So they've learned that. They have a lot of I guess, call it history, that they found what tools that worked and didn't work. So they're applying that all now at a faster, rapid pace. And I hope, because of their expertise, that'll help. But it doesn't help that every time the lawmakers want to give another $1 trillion to some other part of we got to stop the government. Because dumping money into an economy, our economy is fighting that right now. And ultimately, all that money will end up lost in inflation for those lower income sectors.
Yeah, I have another question, and we've gone through this together on a couple of with a couple of clients. We've got a lot of relocations. So a lot of people, that are moving here, that are dying to move to Florida. So some of them I'm not really realizing what it entails relocating. So if you have a relocation package with your job and you'd be working for the same company, it's one thing. But if someone's relocating and they want to move here and they need to, have employment, some of them don't realize what is entailed. And then when they see the difference, and anybody could buy a house. Right. So what do they need to know? Because I just had another phone call. Is the reason I want to bring this up the other day, where someone said, I'm just moving. I said, so what do you do for work? I forget what they said. I says, well, do you have a job lined up? Not yet. And I was like, okay, well, you need to figure this out. They said they had a mortgage broker. I said, you need to talk to them. So what is someone who is relocating need to know as far as employment, and even with remote workers, because that's another one. It's not as, you can't just come here. You need to have things lined up, right?
No, yeah, great question. So there's a couple things when you're doing a relocation, getting with the right real estate and mortgage expert is key to figuring out the logistics and then
Yeah.
the technical piece. So definitely start with Robert. Call Robert, get with him. He'll get you in touch with myself or somebody else on his team. What's important to note about a relocation is the logistics can be so daunting and it's scary. There's a lot of tools that us mortgage people, I'll talk to that, where you can actually close on a loan with an offer letter. A lot of people don't know that. Like, you have to actually have a paycheck, like literally move here, sit in a hotel for 3 or 4 weeks, and then you can close on the loan. And that's not true. So you can literally do it with an offer letter with certain lenders that know the guidelines and figure out how to do that. Get with Robert, get with myself. We'll help you get into that type of program that would allow that. Then you got the rest of the technical piece. What are you going to do with your house and the sale of it, and maybe accessing the money? There are there's bridge loan products that you can do where you can bridge the money from the equity on the house that you're selling to get in. So there's a lot of products out there to help you with that. Don't call just the call center at some place, because all they are is they just know refinances. They're just now getting into the purchase business, but they're they're starving because they're not local purchase-based experts. So get with the right person. The close without a paycheck, just an offer letter, and then work with somebody who's going to help you bridge if you got a house to sell. And then the second part of your question was remote workers.
Yeah.
This has been an awesome opportunity, I think, for a lot of individuals that companies are okay with the remote piece, where if you can get a letter from your employer, HR, not from your immediate boss. Sometimes it has to be directly from HR that you are 100% full remote, or that they authorize you to be 100% full remote, allows you to move to one of the best states ever. Palm trees, water, restaurants. I love Southeast Florida. And so this gives you an opportunity to move to places that you absolutely love. And we can do that. Lenders can do that. Certain lenders can do that know the guidelines, know how it needs to be structured. So absolutely, you can have that opportunity. And I'd also like to just kind of piggyback on something else. There's a lot of elderly parents out there that need to be closer to their kids, and a lot of the kids are buying houses for their elderly parents. The parents might have the money, but they don't have the income to be able to qualify for a home. Well, there are certain programs out there that I have that you can literally buy a second primary home, even if you have a primary home, second primary home, to move your parents, or the parents move their kids next to them within a close proximity. Now that means a lot, especially in Southeast Florida, where there's over 100,000 condominiums in the area, and condo financing is a little tricky. Like, some of them don't allow investment loans, and some of them have like all these weird things. So having a primary residence structured deal could make all the difference, not only in interest rate being way lower,
right,
closing costs less, down payment less, the condo likes it better. So there is ways for you to buy for your kid or for your elderly parent a primary residence as well. So just some food for thought.
Yeah, that's what we ran into. Well, I forget his name. With Nathan, I don't know if you remember. That was a while back. He was all set to buy, but once he realized that what he wanted to do, it was not going to be his primary. And then that was before these rate hikes, and he was blown away by the difference in cost.
Yeah,
and that's why I was asking, because a lot of people reaching out. I mean, I got people calling right now that are just there we go, that are basically saying that they just want to get out of where they are. A lot of New Yorkers that they just want to buy something, and I'm like, okay, well, you need to understand what we're getting into, especially for work, because you got to get your ducks in a row when it comes to that. So we're going to wrap this up. Mark, do you have any other thoughts, and I want to do this again with you, and we'll go a little more in detail, more time, and we'll do some real stats. But you have any other, like for someone who's discouraged about this market, like a buyer, what are your thoughts on, because we have a lot of that. A lot of people are on the fence, and I totally get it. It's a big difference looking at, even say a $500,000 home back in January, if you're ready to purchase it. And now if you're in the same position, your payment's like double. So what do you say to those people that are just kind of like discouraged?
Yeah, be Nike, do it now. I mean, and this might sound self-serving coming from Robert or me, because we're in the industry, but you buying a piece of real estate, not only do you get the value out of it, so the cost, but you stop your inflation on rent. So
Yeah.
we already talked about how there's runaway inflation and how long will that take. I mean, if you're renting, God, man, you got to fight with all your might to get to buy a home. And it's not going to be maybe in your perfect home, the nicest home. Don't be a first-time home buyer that you want to have like the perfect home. No, you got to get there a couple moves, and so get in there so that way you can grab some of this appreciation, and then buy your dream home, your second or third purchase down the road.
Yeah, I always say, what's the interest rate on someone who's paying rent?
Yeah,
it's what, 100%, right?
Yeah.
Yeah, absolutely. So that's what I say too. Plus, they could always refinance, and when the rates go back down. So I say the same thing as get the house, but I understand people's frustration. The market, have you ever seen a market like this? I mean, it's just, other than going through, when I started was 2005. That's when I started real estate. So I kind of knew right when I started, you just started seeing, the cracks in the real estate market, and, you kind of knew something was happening. So I don't say we're anywhere near that, but have you seen a market this volatile as far as interest rates?
Yeah. So I think 2005, 4, 5, and 6, you saw enormous amount of liquidity for buyers to buy stuff with 100% financing, whatever. So you could be, packing groceries at a grocery store, buying your third $500,000 house.
I know.
Like
it was ridiculous.
There was too many buyers for the inventory. So that is what this has felt like for the last couple of years, where there's way more buyers and they're coming in with silly offers because they don't seem like they're really making good financial sense with their offers. It does feel that way. And then all of a sudden now we're kind of we know that rates are going up, so I don't feel it being so volatile. Not like it was in 2007, 8, and 9. Interest rates were like, I didn't even know what to tell people to do. Right now I know generally kind of where things are going based on your timeline, but so I feel it's more stable. We know it's going up. We know that inflation of homes were like 10% or something crazy, or even more than that in Southeast Florida now, trying to get that down to 5, 4, or 5%, where it's usually, that should be like a safe range. So that means the future of appreciation on houses are still going up, but just hopefully not as great.
Yeah, absolutely. All right, Mark. Well, I want to thank you for your time, and we'll talk soon, and then we'll do this, a little bit down the road, and as the market changes, and get your perspective. I really appreciate it.
Perfect. Thanks, Robert. Appreciate it.
All right, buddy. We'll talk soon.
Absolutely.
Okay, bud. See ya.
All right, guys, we're going to wrap it up right there. I hope this video was helpful and you got something from it. And if you have any questions about moving to South Florida, reach out 24/7. And I look forward to making your transition to South Florida a very, very smooth one. I'll catch you on the next video. Take care.